welcome to the debate. Imagine you're offered this incredible superpower in the world of commerce. You can build these massive empires, employ thousands of people, move mountains of capital. But if the enterprise comes crashing down...
The legal force field kicks in.
Exactly. The force field kicks in. If the debts mount and the whole business fails, your personal bank account, your home, your private assets, they remain entirely untouched.
Right. You only lose exactly what you put on the table to begin with.
Right. It is an extraordinary privilege, and it really sits at the absolute center of modern capitalism. But the question we are exploring today is, well, what does society demand in return for granting that superpower? Does a corporation exist solely to maximize profit for its shareholders? Or does that legal privilege of corporate status inherently demand a structural duty to broader stakeholders, specifically society, the environment, and the government?
It really is the defining economic tension of our time, isn't it? I mean, when we look at the architecture of business ethics and corporate law, we have to decide what a company is actually built to do. Are we designing an engine for wealth generation, or are we trying to build a vehicle for social welfare?
Well, I argue that the immense legal protections granted to corporations establish a strict quid pro quo, meaning it requires them to operate with corporate social responsibility and a binding environmental duty.
And my position is that a corporation's core function is fundamentally economic. It's rooted in shareholder primacy, and that corporate social responsibility, or CSR, must remain a voluntary philosophy rather than an imposed mandate.
So let's actually unpack that legal force field I mentioned, because to understand the duty, you really have to understand the mechanism of the privilege.
Okay, yeah, let's do that.
In the 19th century, most states introduced corporate law that separated liability from ownership. Because, before this, if you were a sole proprietor or in a partnership and your business failed, say a train you operated derailed and caused massive damage, you were subject to personal liability.
Right, the creditors could literally come for your house.
Literally.
Which made ownership incredibly risky. And that naturally throttled economic growth because, well, people were terrified to invest in large-scale industrial projects.
Precisely. So the introduction of limited liability completely changed the DNA of business. By protecting owners, directors, and managers from personal financial ruin, limiting their losses strictly to the capital they use to buy their shares, it was like playing poker where you keep all the winnings, but the house absorbs your losses beyond your buy-in.
It's a pretty good deal.
It's an amazing deal. It suddenly made investment incredibly attractive and allowed businesses to raise massive amounts of capital by selling stock. But, and here is the core of my perspective, this incredibly lucrative protection doesn't just exist in a vacuum. It is a legal fiction. It was constructed and granted by society. And in exchange, there is a Latin quid pro quo, this for that. Because society absorbs the residual risk of these massive entities, corporations owe a reciprocal moral and legal duty to a broad set of stakeholders.
Meaning the community, the environment.
The community, the environment, the employees, yeah. The pervasive belief that corporate law requires for-profit companies to pursue profit at the expense of absolutely everything else. It is simply a misreading of the social contract.
I think you're accurately describing the history, but you're drawing the wrong mechanical conclusion there.
How so?
Well, we have to look at what actually makes the U.S. capitalist system function, and it requires definitional precision. Limited liability is indeed the heart of the system, right? It reduces risk, increases the pool of willing investors, and it drives the innovation that elevates society's standard of living as a whole.
Sure, I don't disagree with the innovation part.
Right, but to suggest that this legal structure inherently obligates a company to act as a social welfare agency, that is to completely rewrite the fundamental mechanism of the market. Corporate social responsibility is currently a philosophy. It is not a government-enforceable policy, and there is a profound structural reason for that.
Which you trace back to Milton Friedman, I assume.
I do, because the Nobel laureate captured the underlying mechanics perfectly. Friedman argued that executives who use corporate funds to, do good deeds are essentially imposing a hidden tax.
A hidden tax.
Yeah. Think about it mechanically. A CEO is hired to run a company on behalf of the owners, the shareholders. If that CEO decides to spend millions on an environmental initiative that isn't legally required or donates heavily to a local charity, they are spending other people's money.
I mean, they are authorized to make financial decisions.
But they are acting like a Robin Hood, playing philanthropist with someone else's wallet. And it's based entirely on what that specific executive subjectively deems worthy. Friedman's position is that shareholders should decide for themselves what social initiatives to fund.
Right, the whole return on investment argument.
Exactly. If I invest in a company, my goal is for it to generate a return. Then I can take my profits and fund the charities, the environmental causes, and the social initiatives that I personally believe in. Mandating CSR is analogous to imposing outside regulation, which just drives up costs, distorts the fundamental purpose of the business, and undermines the property rights of the shareholders.
See, that theoretical framework always sounds pristine in a textbook. It's very elegant, but it inevitably collides with legal reality. You're treating the corporation as this cold, calculating machine that only exists to spit out dividends.
Well, economically speaking,
But that's not how the courts have historically defined corporate obligations, nor how they define them today.
actually the foundational legal precedent perfectly illustrates the economic purpose. If we want to understand the deep DNA of corporate law, we have to look at the landmark 1919 case, Dodge v. Ford Motor Company.
Oh, of course. The classic shareholder primacy case.
It is classic for a reason. Henry Ford, in a highly publicized move, announced he wanted to stop paying massive special dividends to his shareholders.
Mm-hmm.
Instead, his goal was to use the profits to improve product quality, expand his manufacturing facilities, and significantly lower the price of his cars for consumers. He explicitly stated that his goal was to employ more men and spread the benefits of this industrial system to the broader public.
Which sounds incredibly noble.
Right? But the shareholders, specifically the Dodge brothers, sued him.
And to be fair, it's worth noting why they sued him. They were using those Ford dividends to fund their own rival automobile company. Ford just wanted to starve them of capital.
Yeah, that's a great piece of historical context, but look at how the Michigan Supreme Court ruled. They didn't care about the interpersonal rivalry. They ruled explicitly in favor of shareholder primacy.
They did.
The court's logic was foundational. They said a business corporation is organized and carried on primarily for the profit of the stockholders. The powers of the directors are to be employed for that end.
Right.
Henry Ford was legally forced to abandon his broader social goals and pay out the dividends. The court recognized that capital is a tool for investors, not a slush fund for an executive's personal philanthropic visions.
Okay, you're absolutely right about the 1919 ruling, but citing Dodge vote Ford as the ultimate definition of corporate purpose today is like, I don't know, citing a 1919 medical textbook to explain modern surgery. I wouldn't go that far. I would. Legal and ethical frameworks evolve. That antiquated view of shareholder primacy has been actively dismantled by modern jurisprudence. Let's look at the mechanism of a much more recent landmark, the 2014 Supreme Court case involving Hobby Lobby. Wait, you're bringing in a religious liberty case to argue for environmental duty? I am. Because the underlying structural mechanism is exactly the same. The Supreme Court ruled that closely held corporations could object to the Affordable Care Act's contraception mandate on ethical, moral, or religious grounds. Yes, they did.
Now think about the structural implications of that. The corporate veil is essentially a membrane. The court essentially said that the personal moral values of the owners can pass up through that membrane to define the actions of the corporation. The business is not legally bound to simply maximize profit. It can prioritize religious ethics over financial expediency.
But that is about protecting the conscience of the owners from government overreach. It is a defensive shield.
But if a corporation can possess moral agency, if corporate personhood under the 14th Amendment grants a company First Amendment rights, as we also saw in Citizens United, it fundamentally shatters the Dodge v. Ford logic.
How so?
You can't have it both ways. If corporations are just profit-maximizing calculators, they don't get religious exemptions or free speech rights. But if they have the legal rights of a person, they must bear the moral and social responsibilities of a person. If moral values can pass up from the owners, moral obligations can pass down from society.
Hold on, you're making a massive leap there. Conferring religious rights to a closely held business to protect an owner's conscience is miles away from forcing a public company to serve an abstract concept like society or the environment at the expense of its shareholders.
I don't think it's a leap at all.
Those are totally different mechanisms. But look, if you want to talk about moral agency and obligations, let's test this exactly where you want to go, which is the environment. Because when you try to translate moral philosophy into environmental regulation, you just hit a massive wall of unintended consequences.
It only seems like a wall because the current incentive structure encourages exploitation. Let's apply what philosophers call deontological or duty-based reasoning here.
Okay.
Think of this as a pure structural moral duty. Businesses are the prime extractors of our natural resources. Therefore, they owe a debt to society for that extraction. It's a simple mechanism of cause and effect. But consider the classic tragedy of the commons.
Right, the idea that shared resources are inevitably depleted because everyone acts in their own self-interest.
Exactly. Imagine a shared public pasture. Every shepherd benefits from adding one more sheep to the flock. The shepherd gets 100% of the profit from that extra sheep. But the cost, the overgrazing, is shared by everyone. So everyone adds sheep until the pasture is utterly destroyed.
A classic economic dilemma.
Right. So apply that mechanism to modern business. When a company needs to dispose of a toxic substance, they have choices. They can dispose of it safely with expensive filtration, recycle it, or, secretly dump it into a river. Dumping is undeniably the cheapest option for their bottom line.
Which is why we have basic environmental laws.
But if we rely purely on Milton Friedman's voluntary goodwill and the free market, the environment gets destroyed because the market rewards the cheapest disposal method. This is why legal scholars like Cormac Cullinan have developed the concept of earth justice.
And what exactly does that mean in practice?
The premise is that the earth and all living things have fundamental rights to exist and to have a habitat. Human systems, including business and economics, must adapt to the fundamental laws that govern the universe, not the other way around.
So wait, giving trees legal standing?
Essentially, yes. Because the free market inevitably incentivizes the tragedy of the commons, relying on voluntary frameworks is completely insufficient. We need mechanisms like a rigid, heavy carbon tax, a literal pay-to-pollute system, as a moral corrective to force corporations to internalize the actual cost of their environmental impact.
I understand the instinct to want to protect the pasture, so to speak, but giving the earth rights at a legal level equal to those of human beings or corporations is a massive, unworkable leap.
Why is it unworkable?
How do you quantify the legal rights of a river in a court of law against the need to build a hydroelectric dam that powers a city? We absolutely must balance development and preservation, but imposing rigid federal environmental taxes or punitive caps stifles the very economic engine that funds environmental innovation.
The engine doesn't fund innovation if it's cheaper to just pollute.
You mentioned the tragedy of the commons, but the solution to that is better market mechanisms, not dismantling a corporation's primary function through a carbon tax.
So how does the market solve a problem it inherently created?
By using the most powerful force in economics, which is self-interest. Look at cap-and-trade systems, which are heavily supported by pragmatic environmental groups like the Environmental Defense Fund, by the way. A carbon tax just slaps a fixed price on pollution, but it doesn't guarantee emissions actually go down.
Okay, true.
Cap-and-trade works specifically because it harnesses the free market. The government sets a hard cap on total emissions and shrinks that cap every year, but it issues allowances to companies. If a company innovates and lowers its emissions below its allowance, it can sell the excess credits to a competitor for a profit.
Right, the trading part.
Exactly. It turns emission reduction into a highly lucrative market commodity. The solution is utilizing market-based economics to align profit with preservation. We don't need to rewrite corporate purpose with abstract concepts like earth justice. We just need to let the market trade its way to efficiency.
I mean, you're entirely right that cap and trade utilizes the free market. I can't argue with that mechanism.
Because it works.
But my issue is your underlying assumption that taking on corporate social responsibility inherently damages the bottom line without these elaborate trading schemes. That is the foundational flaw in Friedman's argument. You claim that CSR is analogous to outside regulation resulting in higher costs. That is empirically false in the modern market.
Well, the data suggests that forced regulation always incurs a compliance cost.
But look at the financial data on socially responsible practices themselves. When analysts compare general index funds to socially responsible index funds over various time periods, the social funds show a highly competitive rate of return, and sometimes they actually outperform the general market.
I've seen some of those studies, yes.
Social responsibility does not mean lower profitability. In fact, progressive corporate managers recognize that safeguarding the natural environment is essential to their own long-term survival. Let's look at a concrete example: Cisco.
The tech conglomerate?
Yes, they consistently rank in the top 10 of the Global 100 list for sustainability. They enforce a rigorous supplier code of conduct. They demand fair labor practices, safe working conditions, and a quantitative reduction in their suppliers' carbon footprint.
Right.
Meaning they track the actual carbon compounds released by fossil fuels all the way down their supply chain. They are embedding sustainability into every level of their business. This isn't philanthropy. This isn't Friedman's hidden tax. This is objective, rigorous risk management and business practice. It proves that the moral minimum of honoring obligations to all stakeholders actually creates shareholder value rather than detracting from it.
I'll give you the financial data point on Cisco. I don't disagree that sustainability can be a smart long-term business strategy, but you're ignoring the crucial word in their strategy, which is voluntary.
But the mandate is necessary because not all companies are as forward-thinking as Cisco.
But the mechanism of how they got there matters. It is an internal corporate strategy driven by market demand. Look at the International Organization for Standardization, ISO.
Right, the ISO standards.
They have developed more than 20,000 international business standards covering everything from sustainability to manufactured products. Countries like Japan and Germany have thousands of ISO-certified companies. But ISO is an independent NGO, and its standards are entirely voluntary.
Voluntary, yes.
Businesses opt into these systems because it makes them more efficient, it builds consumer trust, and ensures long-term profitability. The system works beautifully when it is driven by the market. But the moment the government steps in to mandate subjective environmental or social behaviors, we run into severe structural problems.
Why? Why does standardizing a good practice suddenly ruin it? That assumes government regulation is inherently inefficient or corrupt, while completely ignoring that businesses often fail to self-regulate without the threat of federal oversight.
It's not an assumption, it's an observable phenomenon known as the revolving door. Think of the mechanics of heavy federal regulation. When you exponentially increase government power to force CSR onto the private sector, you create a massive regulatory apparatus.
And you need experts to run it.
Exactly. And who understands the industry well enough to staff those agencies? Executives from the private sector. So they leave their corporate jobs to work for the government. They become the regulators of their former competitors.
Okay.
It's like letting the players referee their own game, with the added promise that the referee gets a massive executive contract from the winning team as soon as their public service ends. They walk right back through that revolving door into highly paid private sector jobs. The relationship between business and government becomes far too cozy.
So your solution is no regulation?
My solution is that this is precisely why there is a strong states' rights or libertarian position on this issue. Limiting federal power and allowing states to regulate or adhering to a less is better philosophy works because states are physically and economically closer to the actual problems businesses face. A state legislature is much more efficient at balancing local environmental needs with local jobs than a bloated federal bureaucracy in Washington trying to enforce a one-size-fits-all concept of earth justice.
I have to push back hard on that.
Go ahead.
That states' rights approach is often just a coded preference for total deregulation. Mechanically, what happens when we leave this to the states? It creates a race to the bottom.
Not necessarily.
It absolutely does. The business community prefers state regulation because states are notoriously softer on enforcement. If a state tries to pass a strict environmental law, the corporation simply threatens to move its factories and its tax revenue across the border to a state with weaker laws. We cannot rely on a fragmented patchwork of state laws to protect the global environment or basic public health, because pollution doesn't respect state borders.
But wait, you're treating all federal regulation as equal. It's not. We can absolutely rely on strict, objective federal mandates when they are tied to a corporation's actual structural purpose, which is financial integrity. If we want to see a mechanism of effective government regulation, we shouldn't look at environmental caps. We should look at the Sarbanes-Oxley Act, or SOX.
Passed after the Enron and WorldCom accounting scandals.
Exactly. SOX applies to publicly traded companies and is strictly enforced by the SEC. But notice what it does. It doesn't mandate subjective environmental goals. It mandates objective financial transparency.
Right.
It makes the CEO and the CFO personally, criminally responsible for errors in their annual audits. It explicitly prevents them from faking their revenue, prohibits shady company loans to executives, and fiercely protects whistleblowers. Why does SOX work? Because financial fraud destroys the actual machinery of capitalism. It prevents investors from allocating capital efficiently.
It does, yes.
SOX is so effective that even private companies, universities, and hospitals voluntarily adopt its internal controls. That is how the government should interact with business, acting as the ultimate umpire, enforcing the objective rules of the economic game to ensure fairness and transparency, not dictating social outcomes.
I am so glad you brought up Sarbanes-Oxley because it actually proves my entire point about the evolving social contract. SOX is a perfect example of society altering the terms of the corporate legal shield when businesses abuse it.
By protecting shareholders.
By protecting everyone, we recognize that the financial fallout of accounting fraud doesn't just hurt the shareholders. When Enron collapsed, it hurt the community. It wiped out employee pensions. It shocked the overall economy. SOX proved that the government absolutely has the authority to pierce the veil of the corporation and hold executives personally accountable for the damage they cause to society.
But financial damage is different.
So follow the logic. If we can mandate rigorous federal controls for financial pollution, why on earth shouldn't we mandate equally rigorous controls for environmental pollution? Toxic waste dumped into a river destroys public health and community resources just as thoroughly as toxic financial assets destroy a market. Both are catastrophic failures of the corporate duty. Both require systemic, mandated oversight.
The distinction is measurement and trade-offs. One type of pollution, financial fraud, can be quantitatively measured on a balance sheet. It is objectively false math. The other involves incredibly complex trade-offs between human development, affordable energy, and preservation.
But carbon footprints are measurable.
But how many carbon tons is a new hospital allowed to emit? When you empower a federal agency to mandate the latter, you inevitably politicize the corporation. You turn a wealth-generating engine into a political battlefield.
I would argue the corporation is already inherently political. It wields immense economic and political power globally, far more than many nation-states. And with that immense power must come a broadened scope of responsibility.
Which brings us perfectly to where the lines are currently drawn in this debate. As we look at the mechanics of all this, I maintain my core stance. The most effective way to ensure human prosperity is to protect the foundational mechanism of capitalism. A corporation is fundamentally an economic engine. While sustainability and environmental consciousness are proving to be excellent voluntary strategies for long-term profitability, enforcing corporate social responsibility as a mandatory duty subverts the very purpose of a business.
Right.
It inappropriately blends private enterprise with government regulation, leading to massive inefficiencies like the revolving door. When we protect shareholder primacy, allow investors to direct their own capital, and rely on market-based solutions like cap and trade or voluntary frameworks like ISO, we achieve innovation without sacrificing economic freedom.
And, well, my closing perspective is that the economic freedom you speak of is not a natural law of the universe. It is a legally constructed privilege. The immense protections of limited liability and corporate personhood simply cannot exist in a vacuum. Society grants business owners the ultimate safety net, the guarantee that their personal assets are shielded from their corporate failures.
Yes.
In return, the moral minimum a firm must undertake is to honor its obligations to all stakeholders, not just the ones holding stock. We cannot rely entirely on voluntary goodwill when the mechanism of the market dictates that the cheapest option is often the most destructive. A structural, legally recognized responsibility to the public good, the environment, and society is the necessary, non-negotiable price of corporate privilege.
Well, despite our fundamental disagreement on the mechanism of enforcement, there is an undeniable point of convergence here.
I think so, yeah.
Whether it is driven by a moral imperative, as you argue, or a profit motive, as I argue, the empirical data is clear that long-term sustainability is becoming synonymous with good business practice. The market itself is actively rewarding companies like Cisco that adapt to environmental realities, proving that profitability and environmental stewardship do not have to be mutually exclusive.
We certainly agree on that. The landscape of business ethics is in a state of rapid, constant evolution. The legal and ethical consensus we see today in our courts and markets is drastically different from a century ago, and it will likely look entirely different 10 years from now.
Without a doubt.
Which brings us back to that invisible legal force field we started with. As society grants these incredibly powerful shields to modern businesses, allowing them to shape the physical and economic world we live in, we must constantly evaluate the terms of the contract. Does the future of our economy rely on the singular, focused pursuit of shareholder wealth? Or does the survival of our society demand a broader, binding commitment to earth justice and the common good? We leave that for you to decide.